Stop what you are doing right now, because this morning, March 9th, 2026, something happened that hasn't happened in nearly 4 years. Something that Wall Street is calling one of the most dangerous economic moments of this decade. Oil just crossed $100 a barrel. And before you say, okay, that's a gas price thing, that doesn't affect me, I need you to stay with me for the next few minutes, because this is not just about gas prices. This is about your grocery bill, your rent, the price of your iPhone, your job, and yes, this is massively connected to silver, and I'm going to break down exactly why silver investors need to pay attention to what happened overnight. As of right now, Brent crude, that's the international oil benchmark, briefly spiked to $119.50 per barrel in the overnight session. That is the highest level since the Russia-Ukraine war of 2022. West Texas Intermediate, the American crude benchmark, hit $101 per barrel. And here's the thing, both benchmarks hit parity last night. They traded at the same price. That almost never happens. And when it does, every expert in the world says the same thing. The global oil market is under immense stress. So let's break this down. What's happening, why it matters, and what it means for your money. 10 days ago, the United States and Israel launched what has been called Operation Epic Fury, a military campaign targeting Iran. And in those 10 days, the world's energy supply has been turned upside down. Here's the geography you need to understand. There is a tiny strip of water at the bottom of the Persian Gulf called the Strait of Hormuz. It is just 21 miles wide at its narrowest point. And through that little strip of water flows 20% of all the oil in the entire world. Every single day, roughly 20 million barrels of crude oil pass through that strait. And as of right now, it is effectively closed. Iran has blocked it. Tanker captains are refusing to sail through it. Insurance companies won't cover ships attempting the transit. The result? A near-total shutdown of one of the most critical energy choke points on planet Earth. And the consequences are cascading fast. Kuwait has confirmed production cuts. Iraq, one of OPEC's biggest producers, has seen output plunge by approximately 70%. 70%. Think about that. Bahrain's Bapco Energy's refinery has declared force majeure. Qatar's Ras Laffan LNG complex, one of the world's biggest liquefied natural gas export hubs, also declared force majeure. And Saudi Arabia's Ras Tanura refinery, one of the biggest in the world, has been taken offline. This is not a small disruption. This is a simultaneous shutdown of multiple pillars of global energy supply. Over the weekend, Tehran itself was engulfed in black smoke. Oil-infused rain fell over parts of the city after U.S. and Israeli airstrikes hit fuel depots outside the capital and across the country. And this weekend also brought a major geopolitical development. Iran named Mojtaba Khamenei, the son of the supreme leader, to succeed his father as the new supreme leader of Iran. This is a signal that Iran is digging in for a long fight. There is no sign of this war ending quickly. And making everything worse, an Iranian military commander made a statement on Sunday that sent shockwaves through markets. He said, and I quote, "Oil will hit $200 a barrel if airstrikes on Iran's infrastructure don't stop." $200 per barrel. Now, is that going to happen? Maybe not. But when an Iranian military official starts threatening $200 oil, markets listen. And that's exactly why you saw prices spike to $119 overnight before pulling back. Now let's talk about what this means at the gas pump, because you're already feeling it whether you realize it or not. According to AAA, the national average for regular gasoline as of this morning is 3,455 per gallon. 1 week ago, that number was about $3. 1 month ago, $2.90. In just 30 days, Americans are paying over 50 cents more per gallon. And here's the number that should make your jaw drop. Analyst Patrick DeHaan, one of the most respected independent energy analysts in the country, posted on Sunday that he believes there is an 80% chance the national average reaches $4 a gallon within the next month, or sooner. Now maybe you're thinking, $4 a gallon. Okay, I've seen that before. But here's what you probably don't know about the math. Every single penny that the national gas price goes up costs Americans $3.7 million more per day. Every single penny. So when we go from $2.90 to $3.50, that's 60 cents. That's an extra $222 million per day coming out of American households' pockets, just at the gas pump. But the gas pump is just the beginning. Diesel is actually rising faster than gasoline. And this is the one that truly affects every single American whether you drive or not. The national average for diesel has already hit $4.04 per gallon. That's the first time it's been above $4 in nearly 2 years. Some markets are reporting as high as $4.16 per gallon. Why does diesel matter so much? Because diesel powers the entire supply chain. Every truck that delivers your groceries, every tractor that harvests your food, every cargo ship offloading containers at American ports. When diesel goes up, everything goes up. Industry data from FreightWaves shows wholesale diesel prices jumped more than 30% last week alone. Retail diesel is up more than 14% in a single week. Truckers are getting hammered, farmers are getting hammered, and within weeks, maybe sooner, you will see it at the grocery store, at Amazon's shipping costs, at every level of the economy. As Ed Yardeni of Yardeni Research put it bluntly to investors this morning, this oil shock won't end until ships can sail freely through the strait. Until then, financial markets are likely to become increasingly concerned about a 1970s-style stagflation scenario. Stagflation, that word is back, and we need to talk about what it means. Stagflation is a word most people under 50 have never had to worry about in real life. But economists are now saying it out loud, and it's the one word that should terrify every investor in America. Stagflation means high inflation plus slow or no economic growth at the same time. In normal economics, these two things don't happen together. When the economy slows down, prices usually come down. When prices go up, the economy is usually growing. Stagflation breaks those rules, and it leaves policymakers completely stuck. Here's why oil creates a stagflation trap. When oil prices surge, it acts like a tax on every business and consumer in America simultaneously. Companies pay more to ship goods, heat their buildings, power their factories. Consumers pay more at the pump and for everything that gets delivered to them. Economic activity slows down. But here's the trap. Those same higher oil prices are inflationary. Prices are going up, not down. So the Federal Reserve finds itself in an impossible position. Do you raise interest rates to fight inflation, which would crush an already slowing economy? Or do you cut rates to stimulate the economy, which would make inflation even worse? And that's exactly what we're seeing in bond markets today. The yield on the 10-year U.S. Treasury bond has risen for 6 consecutive sessions, the longest streak since August. That means bond traders are pricing in more inflation ahead. Traders are now expecting the Federal Reserve's next rate cut no earlier than September 2026. The S&P 500 opened down 1.5% this morning. The Dow Jones dropped over 800 points, more than 1.7%. The Nasdaq fell 1.3%. Airline stocks, which are devastated by high jet fuel costs, got absolutely crushed. Delta down 3.1%. American Airlines down 3.8%. United Airlines down 2.8%. And here's a chilling signal from the transportation sector. The Dow Transports Index, which tracks shipping, logistics, and transportation companies, is on pace for a 9% loss over just the last 3 trading days. That's the biggest 3-day slide since the Liberation Day wipeout of April 2025. When transportation stocks collapse like this, economic historians know it often precedes a broader economic recession. Okay, now we get to the part that I know many of you are here for. Silver. Silver right now is one of the most confusing, most counterintuitive, and honestly most interesting assets to watch as this oil crisis unfolds. And I want to give you the full picture because there are 2 competing forces fighting over silver's price right now, and understanding them is the key to making sense of what's happening. First, let's check where silver is as of this morning, March 9th, 2026. Silver is trading at approximately $83.20 per troy ounce, down about 1.34% on the day. Gold is down 1.3% to around $5,029 per ounce. Both precious metals are falling, on the same day that oil just crossed $100 a barrel. Shouldn't silver be going up? Isn't it supposed to be an inflation hedge? That's the question everyone is asking. And the answer requires you to understand 2 things about silver that most casual investors don't know. Silver is both a precious metal and an industrial metal. About 50% of all silver demand globally comes from industrial applications, solar panels, electronics manufacturing, electric vehicle batteries, medical devices, semiconductors. This is why silver has been on an absolutely historic bull run. In 2025, silver surged 147% from around $31 per ounce up to over $72. It continued into 2026, eventually hitting a peak of around $120 per ounce, levels not seen in modern history. A 5th consecutive year of supply deficits, explosive industrial demand from the clean energy revolution. Silver was on fire. But now there's a problem. 2 problems, actually. Problem number 1, the US dollar is strengthening. When a war breaks out and oil spikes, global investors, especially foreign investors, rush into the US dollar as a safe haven. The dollar has been climbing against virtually every major currency since the Iran war started. And here's the thing about silver, gold, and most commodities. They are priced in US dollars. When the dollar gets stronger, it takes fewer dollars to buy the same amount of silver, so the price goes down. This is not a sign that silver is fundamentally less valuable. It's a mathematical artifact of dollar strength. Problem number 2, recession and stagflation. Fears are crushing industrial demand expectations. Remember, half of silver's demand comes from industry, solar panels, EVs, electronics. When markets start pricing in a recession, when companies are cutting back, when manufacturing slows, when people aren't buying new electric vehicles, the industrial demand side of silver gets hammered. Traders look at a potential economic slowdown and say, if factories are going to slow down production, they're going to need less silver. And they sell. So right now you have an unusual situation. Silver should theoretically benefit from surging inflation, silver as a hedge, supply deficits, demand exceeds mine supply for the 5th straight year. The clean energy megatrend, but it is being pressured by a strengthening dollar, recession and stagflation fears hitting industrial demand expectations, profit-taking after an enormous multi-year bull run. According to analysis from Kitco News and Barron's this morning, silver prices have turned volatile as the US-Iran conflict scrambles metals, markets, and shifts Federal Reserve expectations. And here's the key question every silver investor needs to be sitting with today. Is this a buying opportunity or a warning sign? The bullish case says, if the stagflation scenario plays out and the dollar eventually weakens as the US economy slows, silver could catch a massive bid from both the inflation hedge and the eventual recovery in industrial demand. Physical silver supply deficits are not going away. The clean energy revolution is not going away. The bearish case says, if oil stays above $100, the US economy tips into recession, industrial demand falls off a cliff, and the dollar stays strong. Silver could see further pressure toward the $78–80 range. What do the analysts say? According to FX leaders, the silver market is currently at a critical pivot around the $83 level. A break below this level could open the door to further selling, but physical scarcity on the COMEX, the commodities exchange, could spark a rebound back toward triple digits, potentially $95–100 per ounce. One more thing I want you to think about. The connection between oil and silver goes deeper than most people know. When oil prices stay high for a prolonged period, it raises the cost of mining silver. Mining is an energy-intensive industry, diesel-powered machinery, energy-powered smelting. When diesel hits $4 a gallon, as which it just did, the cost of pulling silver out of the ground goes up. This means miners may scale back production, which tightens supply even further. In the medium term, that's actually a silver bullish factor. It just takes time to filter through. So let me give you the big picture scenarios, because right now, there are really 2 roads this can take. The quick resolution. The G7 nations, the United States, UK, France, Germany, Italy, Canada, Japan, held an emergency meeting today. France's finance minister confirmed afterward that G7 nations are ready to take all necessary measures, including using strategic reserves to stabilize the market. If the Strait of Hormuz reopens soon, if diplomatic channels get activated, if the United States and Iran find some kind of ceasefire agreement, oil prices would likely fall hard and fast, recession fears would ease, silver would likely bounce back toward the 90–100 plus range alongside gold. The prolonged conflict. If the Strait of Hormuz stays effectively closed for another 1 to 2 weeks, analysts at major financial institutions say prices could move toward $130 to $150 per barrel. And if Iran follows through on its threat to target other economic centers across the Middle East, Saudi Arabia, Kuwait, the UAE, we could be looking at a supply shock the world has never seen in the modern era. One analyst at Goldman Sachs has already revised oil price forecasts dramatically. Another from the oil services sector stated simply, the sky is the limit. In this scenario, the stagflation risk becomes very real. The Fed would be paralyzed. The US economy, which is, as the New York Times pointed out today, 40% more oil-intensive than China's economy, would take a disproportionate hit compared to our global competitors. China has been aggressively transitioning to electric vehicles. Chinese gasoline consumption peaked in 2023. The EU's economy is half as oil-intensive as ours. America is uniquely exposed. And one final number I want to leave you with, because I think it puts everything in perspective. Americans spend $3.7 million more per day for every single penny that the national gas average goes up. We are currently up roughly 55 to 60 cents from a month ago. That is an extra $200+ million per day being drained from American households every single day while this crisis continues. That is money not being spent at restaurants, not going into savings, not going into the economy. It is going straight into the global oil market. Here is the bottom line for today, March 9th, 2026. The facts. Oil spiked to $119.50 a barrel today, the highest since 2022. WTI and Brent briefly hit parity, a historic warning signal. The Strait of Hormuz, carrying 20% of global oil, is effectively closed. National gas average, about $455 per gallon and rising fast. Diesel is above $4 per gallon, hitting truckers, farmers, and your grocery bill. Iran has threatened $200 oil if strikes don't stop. Silver is at $83, caught in a war between inflation fears and recession fears. Gold is at $5,029, also under pressure from a stronger dollar. The S&P 500 dropped 1.5%. The Dow fell 800 points. And the word on every economist's lips is stagflation. What you should do, stay informed, keep watching. Do not panic buy or panic sell anything. This situation is changing by the hour. The G7 is meeting, strategic reserves may be released, diplomatic backchannels exist, markets can reverse as fast as they spiked. But you now know more than 95% of people about what is actually happening in global energy markets today, and why it matters for your wallet, your investments, and your future. If this video gave you value, please like it, share it with someone who needs to know this, and subscribe so you don't miss our next update when this situation develops. And drop a comment below. Are you buying the silver dip or waiting for more clarity on the war? I read every comment. Stay safe, stay informed, and I will see you in the next video. This video is for educational and informational purposes only. Nothing in this video constitutes financial advice, investment advice, or a recommendation to buy or sell any asset. All data presented is sourced from publicly available news outlets and market data as of March 9, 2026. Markets are volatile and unpredictable. Always consult a licensed financial advisor before making any investment decisions. The creator of this video assumes no liability for decisions made based on this content.